Director of Trading Operations for Time Leverage Capital. For anyone who missed our previous webinars, give us a call at 800-519-9085, and we can send you the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so that we can prepare a lesson plan based on your level, at your pace, and on your schedule. Now, for an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please be sure to read and understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and served as chief strategist of the Dow Jones Megatrends and All Markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage, Time Leverage Capital, and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Introduction to Buy and Call Options webinar. Mr. Mueller?
Thank you, Roy. Welcome, everybody, on a beautiful Tuesday. And we're going to get right to our sequence for discussing when and how to select a trade. Today, as you know, we have multiple training calculators so people can learn different instruments from stocks to futures to ETFs and so on. And we go from basic calculations all the way up to spread and synthetics, and then finally to the master combination calculator, which is an all markets calculator and all instruments calculator. Today, for purposes of our discussion, we're going to go straight to our option strategy gallery, where we will review the scenario when a person wants to buy a call. Buying a call is one of the foundations of understanding option trading and is one of the more commonly understood and utilized strategies for people who employ options. First and foremost, let's go to the scenario that would warrant somebody to purchase a call or to buy a call or be long a call. In our strategy gallery, we have two factors, and in this case, if you want to buy a call, the first factor that most people are familiar with is that you have a bullish market outlook. You're expecting the market to go up. You should be aware that the bullish market outlook alone, an upside direction expectation alone, is not necessarily a sufficient reason or basis for buying a call. In fact, it is possible to have a bullish direction, to buy a call, have that bullish direction materialize, and still lose money on the trade, as you will see, because in addition to requiring a bullish direction, the purchasing of a call also requires an expectation of rising volatility. So for those of you, and we will have this discussion later on, volatility is the bounciness or the range of the market, the implied panic level or expectation of large moves that is factored into prices or options. We're going to put out a poll, so anybody who needs to understand volatility better, please answer yes on the poll, because we will get you that information. If you don't understand volatility sufficiently well, you will have a very difficult time making informed decisions in trading and certainly in options. So now to go to the basics, a long call is a scenario when you expect prices to go up, and with rising volatility, the better the call that you buy, the greater the increase in volatility and explosiveness of the upside move. And let's look at the particulars. Whenever you have a trade like this in the strategy gallery, you'll be able to click on the trade and see the particulars of the outlook for when the trade is done. Very shortly, there will be actually a play button here, so you will be able to see a complete description every time in one of our training videos. And that will also take you to our demo section, where we'll have demonstrations on how to input the trades, as well as additional terminology and definitions. Now to brass tacks. As we discussed, buying a call is a directional trade. If you don't feel strongly that the market's going up, and with conviction, a long call is not the instrument to use. The maximum profit on this trade is unlimited. The profits increase as the market moves higher, and volatility increases. The higher it goes, the more the volatility, the better the trade. The maximum loss on purchasing a call option is limited and predetermined. That is, you cannot lose more than the premium that you paid for the option and the fees and the costs. So you have to pay the total, and that premium includes your costs, as you will see in greater detail when we do the spreadsheets. This graphic, which is one of the old ways of looking at this, we prefer the new way, basically shows here that if somebody purchased an option with a strike price of 84 in X market, if they pay 2 points for it, then the market has to get beyond 86. It has to overcome the cost that they paid, the premium paid in this area, before their trade can become profitable. And as you can see, the greater the extent to which that premium is overcome, the larger the profitability. So you have a trade that on the surface is very attractive. It's got an unlimited profit potential. It's got a limited risk outlook built into the trade. And the trade-off, and this is why many traders find out that this perhaps sounds better than it sometimes is the caveat. Time decay is a minus for this trade. So the position is a wasting asset. The more time passes, the value of the option will decrease. So if time passes and the market doesn't do much and it doesn't go anywhere, staying where it is doesn't mean it's going to break even. Staying where it is means that time will erode the premium, and the closer you get to the expiration, the greater the time decay. So when putting on this trade, always be mindful of time erosion, and that the move in the market is greater than the effects of time erosion on the position. So again, when you will get to this position, you're going to see a click. You'll be able to click either to a demo video of how to input a trade, or you'll be able to see a number of examples of these trades from previous webinars as well as based on current markets. Excuse me, I think I'm having a little bit of a sore throat, rising volatility, so bear with me while I get a sip of water. Thank you very much. Okay, now let's move on. Now that we've seen the particulars of the trade, let's go ahead and move to some examples. And for today, in order to make these trades more comprehensible, we've actually put together some examples and some made-up scenarios, if you will, or some hypothetical scenarios of when a person might use such trades. And obviously, these scenarios are not going to apply to everybody. The first case that we have is a contract market in the S&P 500 index. As you know, when we click on the trade, the contract market, the contract specifics come up. In this case, we're doing at 250 times the S&P 500. This is a significant contract. If you are looking at the S&P market and where those valuations are, we're probably looking somewhere, let's say for around 1870, that market's actually higher. We're looking at a contract that's somewhere around $468,000 in leverage, the S&P being around 1872 and change. So this is a very large contract, we are nudging $500,000 worth of leverage. So let's say John Smith is retired, recently retired, and has a very large portfolio of stocks. He's extremely concerned about the situation geopolitically. There's instability in various parts of the world, and he feels that finally, at long last, the stock market may collapse significantly, and he is extremely concerned to have his entire portfolio in the stock market, especially as he's anticipating, let's make up a number, and he could be right or wrong, this hypothetical person thinks there could be a 30% correction in the market. Well, as you know, that if there's a 30% correction in the market and somebody has, let's say, a portfolio of 400 and let's call it $70,000 in order, for argument's sake, you take $470,000 and you calculate a 30% drop in the market, that would be a drop of $141,000. So that would be a very significant loss. This particular person is afraid of leaving that kind of stocks on the table. On the other hand, he also thinks that there's a remote possibility that through government intervention and various actions, the S&P could take off and go to 1950 or 1960, in which case he says, well, on the one hand, I don't want the risk, but I don't mind if it goes up a little bit. But if it goes up a lot through some government intervention or some surprisingly positive news around the world, I want to participate. So in this particular case, this person would become a long hedger. He would say, I want to participate if the market goes up, but I don't want to stick my neck out indefinitely for a large drop. So what this person says is, okay, I'm going to replace my stock position in this particular case, for argument's sake, of somewhere around $470,000 worth of stocks. I'm going to take them off the table. I don't want to lose $140,000 if the market goes down 30%. Instead, I'm going to buy a call with a strike price of $1,900. And again, as you know, when we click on the strike price, we learn how to do the inputs. We have the premium definitions. We input the costs. We input the rows, and then we calculate the trade. And in this particular case, this gentleman says, let me see what happens. He says, well, if I come out and I flatten out my position, he would turn around and spend $8,555 to participate in a rally. The calculation here would be the following. This person would think, if this person says I could lose $140,000 if I stay in on a 30% drop, but I can speculate with $8,555 on a big rally, if this person's particulars would be such that he would say, I can't afford to lose that much, but I want to participate in this and just speculate with this tiny portion of what I took off the table, and then he perhaps won't kick himself if there's a significant move. So let's see. If there is indeed a large move in this market to 1950, 1980, 2000, I mean, these numbers may seem extraordinary to some, but we've had some astonishing rally through some difficult situations. So this person says, I don't want to miss out. I don't want to kick myself. They buy this option, and as you can see, they have a limited risk. If they sit on their hands, they don't offset their position, they wait to expiration, the most this person can lose $85.55. Of course, if the market tanks the 30% that he feared, he will be rather glad to only risk this much relative to what could be lost intrinsically on an entire portfolio. On the other hand, if there's a small rally, again, he may not gain intrinsically because he's looking for a large move, but once those large move occurs, that would be impactful in terms of what he's missing out on his portfolio. As you can see, the profit scenario goes up and is unlimited, so we can increase the number of rows. And again, we're talking about some pretty lofty and extraordinary numbers here, but we can just do the math on it. Again, on a drop, the risk is predetermined. On a rally, the numbers get larger and larger without a cap. The most important thing in buying a call, especially when you make this type of an investment, is to monitor your premium closely. Your premium break-even on this trade, or the premium break-even rather on this trade, which is calculated in the summary box here, as you can see, is 34.22. So that premium can be monitored at all time, and the position can be offset before expiration. My general expectation would be that when somebody purchases an option like this, if they have significant profits and they think the move is done, they can take them out before expiration and before all of the time erosion has its impact. Or if the market doesn't do anything, if it stays flat, if it goes down a little, if it goes up a little, there can be some kind of a decision that if somebody sees this premium trade down, let's say to 24.22, to make my math easier, that's 20 points, that's $5,000, the person would say, okay, I'm going to go ahead and I'm going to go ahead and adjust my position and come out of this position. So again, you can set a loss based on premium. You can monitor futures, or you can just say if you have 30 days to expiration, you're hitting a period of major time erosion. It would be foolish, in my opinion, to incur the maximum risk on such an expensive option. Although it is the maximum theoretical risk, I also think it's rather foolish to watch an option this expensive expire worthless, especially with time erosion when it becomes very relevant.
Yep.
On the same scenario, I'm sorry, go ahead.
We have a question. Yeah, there's a question. He wants to participate in the upside move, but he's not super bullish and doesn't think the market will explode to the upside. Is there some other way he can trade this?
Okay, actually that's a very good question. And again, as you can see, again, remember this particular trade, as you see in the dialog box, we always have a reminder of time decay being a minus here, and you want an up direction true, but an up volatility. The minute that the outlook changes from volatility up, this may no longer be the trade to do. So in a case like that, and certainly we've done this before, we can go back to the strategy gallery, and we would have look for a trade that is a bullish trade, but with less volatility. So in this particular case, let's say it's not volatility rising, but if it's volatility falling, you could look at these types of trades. And again, both of these are margin trades, so the person would have to be mindful of margin. And then certainly on an undecided volatility trade, you can look at a bull-call spread, which can be a non-margin trade if it's a 1-by-1, and probably this trade, or perhaps a short butterfly under certain circumstances with undecided volatility, would become the trade of choice. So once the outlook changes, we can't really change this trade a great deal as to composition to make up for the fact that the volatility outlook is not explosive or bullish. So again, what you might do then is take this trade and do a bull call spread instead, and in fact we can save these numbers, and when we go back and do bull spreads as we've done before, we can see an illustration of how the profit and loss table changes. In fact, anybody who's attending today will be doing a spread program tomorrow afternoon, and we can actually run a couple of examples on a smaller move, because it's actually wise when somebody looks at the spreadsheet to say, wow, I'm covered for an upside move, but goodness gracious, 1940, 1950, anything is possible, but is that really a range that I think is realistic? So for somebody following the S&P that does not think that that is a number that they feel comfortable with, especially given the premium outlay, they might look for a strategy that has a smaller volatility outlook to better meet your needs, and that's why the option ranger is designed this way. So you can find a range where the numbers are consistent with your expectation. In this particular case, this is a long hedge. It's not necessarily something somebody might do on spec based on expectation. Everybody's situation is different. Now, one thing which is very important in selecting instruments, and I'm just going to take a moment with it, is, for instance, the possibility of using the E-mini. Again, you have all the same descriptions, the time decay, the direction is up, the volatility is up, but now you have different contract specs on the contract. It's 50 times rather than 250 times the index. So now if you're looking at 50 times the index, you're probably looking closer to about 90, maybe 94,000, 93.7 and change, depending on where this thing settled out. So now this contract is 1/5 the size. So if somebody says, well, I don't really want to hedge or have a long hedge again on a portfolio for 400, close to 470, I'm really looking more at something around 94,000. So in that particular case, you can use a different instrument, same strike. Obviously, the costs are significantly lower because there's less leverage. We factor in the cost, and now the premium break-even is 35.1. That's what you monitor day in, day out, both to offset for profits if you're up or to try to salvage with losses if you're down. As before, and this is very important, when you buy a call option, your maximum risk is limited and predetermined to the amount of money that you initially invest, which, as you can see clearly, consists of the premium that is paid in the marketplace and the transaction costs that you should list in their entirety so you know exactly where your break-evens are. The break-even on futures, again, is at 1935.1, because although you have a call which gives you the right but not the obligation to buy the S&P at 1900, you're not profitable at 1900 intrinsically. You're profitable at 1900 plus the 35.1 in premium that was paid for the position. That's why at expiration or intrinsically at any time, the break-even is at 1935.1. Mostly people will offset prior to expiration so that in addition to this intrinsic value, they can have some volatility or premium as well, especially if on an upside move with rising volatility. Again, as you can see now, you have, no matter how low the market goes, the loss here is 1755. So in this case, gentlemen, our imaginary Mr. Smith, at his retirement, instead of taking a hit of, let's say, 30% on 94,000, is going to take a significant, which would be about 28,200. Now would be risking as little as 1755 to somehow participate in an explosive volatility rising rally.
We have another question.
Again, yes.
Is it a good idea to sell the option I'm in if I can double or triple my investment and replace it with a cheaper one to build up cash and use it to diversify to other markets if I feel the current move is not over?
If you feel that the current move is not over, you certainly can be, it's always wise to take a certain amount of money off the table if you're in profits. There's a saying, it ain't a profit till it's in your pocket. What you have to be mindful of doing is you don't want to take a position that is a quality position that's gaining, that's in the money, and replace it with an out-of-the-money position that becomes a long shot. And actually, I think that for those who want to talk about which options to buy and which to replace, I would like to put out a poll on what kind of understanding we have in there of in, at, and out-of-the-money options, because usually that's the type of swap you would be making. You would be swapping an in-the-money option or an at-the-money option to perhaps replace, you'd be offsetting that to buy something out of the money. The first point is that if you feel that the market is done, taking money off the table is good, and reinvesting a portion may also be good. I think there should be some substantive difference between the two positions besides the money management ingredient. Are you buying more time? Is there a volatility outlook change that takes somebody from perhaps just having a straight long call, as they do now, to maybe legging into a credit trade or a free trade. So for instance, let's say in a scenario like this, and again, we're going to just strictly talk hypothetically, let's say somebody buys this 1900 call. And the market takes off, and and this call is past break even, and it's at, let's say trading at 55.1. So it's up 20 points. In addition to just offsetting it and perhaps replacing it with something farther out of the money, which becomes the farther out it is, the more of a long shot it is, a person might decide to collect back their premium that they paid and sell an out-of-the-money option, leg into a free spread or into a credit spread or a very cheap spread, and still maintain their initial position and take money out of the trade, not so much by offsetting, but by collecting money against an inflated option. So if the outlook changes, let's say from rising volatility to the market's going to continue going up but with undecided volatility, you would find in our strategy gallery that that's a bull call spread, as we just saw. And you might make the straight-up decision at that moment, and again, we'll have webinars and forums to discuss these alternatives, to say, you know what, I'm going to turn this into a free trade. I'll keep my long leg in there. I'll pay for it by selling the next guy a long shot farther out of the money. And if the market keeps going up gradually, I'm still gaining on my foundation. You can use that money to diversify into other markets, have on the side, take home, and so on. If you expect that the volatility, that the market is going to have diminishing volatility, not just undecided volatility on a rally, then you might turn around and sell, instead of one call, perhaps sell two calls, depending on how wide your spread is and what your risk tolerance is for margin. So it is always important, especially when you're engaged, to figure out how to take some of that money off the table, how to protect gains, but don't replace a trade that is directional with one volatility, with a particular volatility outlook with an identical trade. In that case, all you're doing is you're paying an extra round of transaction costs and not necessarily getting any additional benefit or change of direction. If you think the market's going to continue to run, not only run, but now volatility will explode off the map, then you can certainly sell one of these options and maybe buy two more out of the money. But again, that, looking at our strategy gallery, again, is a trade that looks for rising volatility in the direction. And in fact, as you can see, that kind of trade is actually here. It's a call ratio back spread, where you sell a call, which would be an existing call, and you buy two higher strike calls. So although this, in essence, would be an adjustment to an existing trade, the composition of increasing position size, going higher out of the money, is actually something that is already accounted for in our strategy gallery under bullish scenario with volatility rising, and actually is for a higher rise in volatility than a long call when we go farther out of the money. So we're actually, when we do examples of different spreads, call spreads and back spreads, you'll see the extraordinary flexibility of these instruments to be adjusted in accordance with our outlook. So so we will get to that particular strategy as a follow-up as well. It's a very good question, and it just depends on your shifting outlook and your evolving understanding of where you think a market is going, and is the volatility going to increase. Volatility that's high but continues at the same level does not mean a volatility increase. So let's say we've seen recently some big moves in crude oil because of instability in the Ukraine and the Crimea with Russia. Those events added a lot of volatility to crude. Somebody was buying calls thinking its market's going to go up and volatility is going to be high, can't just think it's going to go up. They'll have to think that volatility will not just be high as it is now, but that it's going to increase from these levels. Otherwise, volatility that is already high is factored into the price, and you will need an even larger move to overcome that premium. Okay, let me go back to our example. So here we have this example again, even at 1755 outlay on the equivalent of about 94,000. I would have very strict risk management policies by monitoring premium and watching futures prices and expiration dates, so that this is the maximum possible loss, but that one should not incur that maximum possible loss if the market trade's not working out. You salvage here and then you roll forward as well, depending on your outlook. Okay, let's go to our next example very quickly. Now, both these examples were a long hedge. A long hedge is somebody who's kind of protecting themselves against the market going up and missing out. So a lot of people are afraid of coming out of stocks or some other investment, although they're worried about their safety or the future of those investments and the risks. They're just afraid of coming out because they think they're going to miss out on some gains. Being a long hedger is a way of taking money off the table to mitigate risk, to reduce risk, and leaving a little bit on there to participate in a move. There's less made, obviously, on an upside move, but there can be significantly less loss in a drop, and this would be a long hedge. And from the standpoint of providing an example of another long hedge, we've put up an example, and it's not uncommon for us to have these kinds of conversations in the corn market. So let's say our good friend Fred, the farmer, has corn, and he is thinking corn prices are looking pretty good. Today, this is on March 4th, we're seeing the May contract up 13 3/4 cents at 44 1/4. So he says, oh my goodness, I think prices are pretty high. I want to get out of the physical market. I'll collect enough by selling here to have a great year and buy my equipment, update my farm. So he's going to say, I'm going to get out of all my physical corn. And then a part of him says, well, what if the market takes off over the summer? There's some major drought, there's some major event. There's going to be a huge windfall for the guys who held on, and I'm going to be sitting there singing the blues because I played it safe and I got out early. So Freddie the farmer decides, I'm going to take my chips off the table just in case, but I have 25,000 bushels that I want to take a chance on a bigger move so I don't kick myself when it moves. So for 25,000 bushels at 5,000 bushels per contract, with 5 contracts, our friend Freddie has got 25,000 bushels. These are the tick values. You can go here for complete contract specs. Here for strike examples, go here to learn more. So he's going to buy himself 5 December 480 calls. This way, although he sold the positions, he's going to say, I have the right, but not the obligation, if this thing's run, to get back in and make some money back. We input the premium, we input the costs and the rows, and let's see what this does. Okay, now again, we see that our friend now has invested $11,000 at an average of 44 premium per position. He's got 5 of them. So that's $11,000 in terms of premium points. We are factoring in the commissions at a default of 55. So his net debit, what he would be laying out total, is 11,275, and that would be it. No matter what happened, if corn became free on the sidewalks, he never came out, didn't adjust, didn't salvage, didn't write premium. That's the most textbook that can be lost, as we label here prominently in the red. The futures break-even point at 45.1, obviously, is that the market has to go up 45.1 cents above the strike price to overcome the premium that he paid. That's intrinsically. So on expiration date, the market has to be above 525.1 intrinsically for him to break even on a straight after costs. Prior to expiration, these premiums are moving all the time, and if volatility goes up and direction goes up, these premiums should benefit, and you need to monitor them closely, both to consider taking a profit, and if things don't go well, to determine when and how you want to mitigate or reduce your losses. We've got the contract specs here, and again, we're looking at expiration, although we monitor all the time. And our friend here, he's got, he's got his 25,000 bushels off the table. If the price of corn goes down $1.50 a bushel, which is, pretty significant move, but let's say for argument's sake he has that concern, then he could live, this person on the physicals not having offset early could be out $37,500 on those bushels. Now they've got a maximum to keep their foot in the door of 11,275 at risk, and there's a potential, if there's a drought or some major movement, to start recovering some of the money on the contracts that they took off of the table to be safe. Again, I would be monitoring these premiums and in all likelihood not risk more than 50% of the premium, or monitor for a 50% alert to place a market order to exit. And of course the market order is just that. It's a market order you get filled wherever the market is trading once the stop is activated. So again, as you can see here, this again is a long hedge. It's somebody who's not speculating that corn will go up. It's somebody who is out, has got their cash, and is just trying to participate with a proxy of a long call in the move. Another person just as easily has nothing to do with corn and has no financial interest physically in the corn itself, might do this strictly as a speculation. So let's say Fred speaks to his Fred's the farmer. Let's talk to Sammy the speculator. Sammy the speculator has a friend of his who has spectacular access to meteorological information and forecasts, and Sammy's friend swears, Sammy the speculator's friend swears up and down that there's going to be a big drought this summer, and Sammy believes him. And Sammy says, okay, there's going to be a huge drought this summer. I'm looking for corn to go up huge with rising volatility. I'm going to roll the dice with $11,000, pays my fees, and now he's not hedging. He's just betting on corn going up because he thinks it's going to go to $7 because it's been there before on lousy weather, or he thinks it's going to go to $6.50, and he thinks it's a good speculation. So then, instead of being a long hedger, as the S&P example that we gave, as the corn example that we gave previously, this person, Sammy the speculator, would just be betting on an upside move with no physical offset against it. It's very important when you trade, because there are two ways really of working in these markets, to ascertain if you see yourself as a long hedger, meaning you want to simulate a stock portfolio or some other investment, or whether you are a straight-out speculator, meaning that you want to take advantage of what you see as upcoming price moves. So when you define yourself that way, you need to do it in your account documents because you receive different treatment, and certainly you need to define it in your own thinking. So I don't know if we've done a poll on this yet, but I'd like to ask the folks that are attending to let us know whether they think there would be, in all likelihood, when they're buying call options, if they envision that as a need for hedging, for business, or if they envision the usefulness for that as part of speculation. And you should know in your own mind which it is, and let us know, because we may be able to better direct you in terms of which trades to review, and there's clearly a big difference between a hedger and a speculator. Hedgers also may be entitled to certain other types of margin treatments and advantages that you should be sure to review in your own specific case. The final example that I want to show, and again, this can be an example both for a long hedger and a speculator, and just to show the variety of instruments. In this case, we're looking at the NASDAQ. There's the Dow Jones, there's the S&P, all kinds of instruments are available on the stock indices, the mini Dow Jones, to either have proxy investments or to have ways of balancing out an existing portfolio with an option position, whether it's a hedge or a spec. And in this particular case, we're looking at the mini NASDAQ. The contract size is 20 times the NASDAQ. So let's say if the NASDAQ is around 37.15, we're looking at a contract whose value is around 74,300 ballpark. So this is a pretty significant amount. If somebody said, I want to be a long hander, I want to take out about $75,000 worth of NASDAQ stock, but I don't want to miss a move altogether in case it explodes. Again, it's a volatility outlook, is an up volatility up direction. So a person like that might turn around, take their risk off the table, spend, in this case we looked at the 37.30 call for 83, and again with the tick value, which is all calculated and described here. As you can see, you can also go to the contract specs, which are listed here. The person would spend a total of 17.15. Again, when you buy an option, you have the risk but not the obligation. In this case, you have the right but not the obligation to buy the NASDAQ 100 mini futures at 37.30. With a premium that's factored in here, the total cost would be 17.15. With costs and commission, your maximum loss, as before, is the total that you paid, premium and fees, and not more. That is the most you can lose, textbook, and again, you have to sit on your hands till expiration and not offset in order to incur that maximum loss. If you're going to buy calls, if you're going to spend premium, you should be as particular in picking what you do and selecting direction and strike price. You should be equally particular in deciding on an exit strategy. If you're going to spend $17.15 on a trade that has time and value, I think it would be absurd, barring some kind of a major disaster in the markets, to incur that maximum loss without a prior exit or review of the position. So again, we see here that we're looking at this contract. No matter how much the market drops, it can go to 3,300, it can go to 3,200, it can go down to 1,000, doesn't matter. The maximum risk when you buy an option is the cost of the option. And here, as you can see, on the upside move again, if the NASDAQ really takes off and this person salvaged their 75,000 in fear of a large drop, at least on a very big rally, some of those numbers intrinsically start being recovered on these tick values. Again, if you think these numbers are not realistic or don't give you sufficient coverage, a long call may not be the strategy for you. And this is the way to find out, by doing this calculation. Again, in a trade like this, it is unlikely that you will wait till expiration for this intrinsic value to materialize. You probably will continue monitoring the premium and making sure that if your break-even is 85.75, that whether you're up 20, 30 points or down 20, 30 points on this trade, you're monitoring the premium to make updated decisions on how to stay and how to follow up. Based on the previous question, and it was a very good question, on when do you get out, how do you roll a position forward, this is what we're going to follow up in our webinars with our existing positions and also in the forum. So for instance, let's say if we get to a point where this option appreciates to, let's say, 110. Person will say, do I want to offset this option, walk away a winner? Do I want to leg in some kind of a spread? And that's when we go back to evaluating the direction, the updated and current directional and volatility outlook, and in a disciplined manner based on those factors, which we are always going to, our directional outlook and our volatility outlook. That's how we make a reasoned decision with those two factors always in play on what do we do if this thing gets to 110. By the same token, what if this option starts trading at 55 and it's down? We have to do the same thing. Unless we have some kind of a strict money management discipline to get out, we review the trade, we review the premiums, we review how far in, at, or out of the money the position is, and with an updated outlook of volatility and direction, we come up with a follow-up strategy that is appropriate based on staying informed on our measurements. So again, we have here, as you can see, this is on the NASDAQ on the smaller contract again, which would be roughly working on a portfolio of 75,000. Again, for people who do not think that the stock market is going to continue to explode at this rate and are afraid of a drop, buying a call like this may or may not be the appropriate move. So I think that these are some of the examples. We focused on some long hedges, but any example here can also be used for a speculator. And finally, we have this here. We'll get rid of it after today. On the 24th, we ran an example of buying sugar, and I just want to come up with some values to show you how these trades evolve. At that time, we looked at a 17 call at about 50 points in premium. It was a relatively cheap trade. Again, it's speculative. We're not saying we did it. We're not saying we didn't do it. This was just a modeling of the trade. And as you can say intrinsically, the market settled at 1774. At 1774, if you look at the basic values here, the trade is hardly making money. In fact, at 1774, I just did the math very quickly. Based on current values, the option settled at 107, so we paid 55 for it. Let me just go ahead and show you those values. You can do all this real quickly with a calculator because we have all the tick values are right here. So if we paid 55 for it and it settled at 107, that means that we picked up 42 ticks here. I'm sorry, 107 minus 55, just a moment. We'll do a quick math on my calculator. And assuming that, I'm sorry, that's 52. So assuming that somebody bought it at that price and could offset at today's settlement, it's 52 ticks, then it's we have the tick values there at the top, as you can see. Tick value is $11.20. So we take your 52 points times 11.2, and you would come out with a net gain of 582.40. Now again, oddly enough, this position has gained 52 points, but the market is not intrinsically far enough. So this is a place where you already start considering an offset, because at expiration, that position would be barely gaining, whereas right now, because of the increasing of volatility in the price movement, the position could be offset. So in a case like this, the person would have to decide, well, do I want to go ahead and take this trade, which was an initial outlay of, assuming these numbers and these entries, initial total outlay of 615, a person might say, well, you know what, I'm going to go ahead and capture those gains, or they might say, let me go ahead and keep this position with a stop, or they might decide to convert this trade, and we can do a demo on it another day of converting this into a free or a very cheap trade by selling a more juiced up, higher volatility out of the money call against the current call that has gone in the money. So again, this is a scenario where you can actually see how the volatility picking up in addition to the price movement can inflate the value of an option and give you an opportunity before expiration, before these intrinsic numbers are all that matters, to achieve an offset. So these are our examples on purchasing a call. Again, when in doubt, remember that you can go to two places, very important places where you can learn more. You can go to our reference materials. We have demo videos on how to input these trades. We have demo videos on how to analyze these trades and follow them up. And we have also option sheets that are going to give you better definitions of some of this terminology so that you can continue updating your definitions and your understanding on the fly. Are there any further questions?
No, not at this time.
Okay, a rebroadcast of this webinar will be available to those of you who want to see it again. And if you want to map out any of these trades, be sure to set up your own login. Be sure to set up your own tab so you can start modeling these out and making all of the changes and all the necessary modeling and the calculations to have a good sense of what you need to accomplish for these trades to make sense. So thanks again for attending. Keep working at it. The information is very important. Knowing how to trade is very important. There's only one person that you need to count on, that you need to lean on when important financial decisions have to be made. Ideally, that person should be you. People should know enough about investing in their own portfolio to take care of themselves.
I'm going to go ahead and launch the final poll. I did notice that several people arrived late. Just as a reminder, if you you came into the webinar late, you will receive an email tomorrow that has a link to the full webinar that you can watch at any time. That's it, and have a good afternoon.